clearly established that the path of financial freedom or towards financial freedom or independence is a very customized concept. So Feroze, so far, what has been your journey? Where are you in this particular journey? And what's the kind of change that you've gotten within yourself to be the change that you want to see, Feroze?
Uh, Good evening, Kavita, and to everyone, happy Independence Day in advance. Today is the eve of Independence Day. And you've taken a very apt topic. I think, like you said, the definition of financial freedom could be different for each of us. But yeah, there is a mathematical definition. There is also a subjective definition. I'll just first tell you how I like to define my financial freedom was if everybody in my family can retire on a particular day and not be worried of money, that if that's the kind of money I have, then I would call myself financially free. If I can get my brother to retire, my bhabhi to retire, my sister, because if you have time at hand, you need family to spend the time. Otherwise, you'll get bored. So that was my definition of financial freedom, that everybody in your family could retire. If that kind of money is there, then it's financially free. And none of my relatives are working. Okay, and God has been kind that, yeah, somewhere thereabouts you could say that. And now comes to the second part of the question. What is the change I would like to see, and have I been able to imbibe that? I think I'd like to see three changes. Unfortunately, it's a longish answer, but I'll try and keep it brief. The first thing is I wanted to, unlike in the past, because my dad always told me to invest very conservatively. But not respecting inflation is some message I got from my previous generation, which is the only thing which I disagree with my dad after having grown up. Everything else I agree. But respecting inflation and doing the right asset allocation, I think, is very critical. India has only 7% of the Indian household savings is in equity. This is a complete disrespect to the risk of inflation. And that's one thing which I want to see as a change in India. In the next 10 years of freedom, in the 87th year, I would at least want 30-40% of this money, if it has to beat inflation, 800 lakh crores needs to be in equity. And I have respected that by not having more than the debt allocation needed for longer goals. That's one. The second thing which I would like to see is respect wealth creation as against money creation. People love to get tips, which is the hot mutual fund, which is the new NFO. People respect money making as against wealth creation. After 2008, I can proudly say I've not bought one stock, and my portfolio has done well, reasonably. And I don't want to be pompous about it, but I've created wealth, not created money on tips. That's the second thing. And the third thing I would like to see India invest in is patience. And I think I can proudly now say that I've tried to be far more patient, unlike in the 2008 and the 2013 crisis. I've become far more patient with my investments, and I don't track them every single month and expect them to deliver for me every single month or every single quarter. And I give them time, like I give a child time to grow.
So, Feroze, taking this risk conversation ahead, one very pointed question to you. Can we achieve financial independence without taking risk in your investments?
Not taking risk is the risk itself, to my mind. Okay, and risk is also so subjective, right? It is not just the market risk. What intimidates people, investors, youngsters, or even the people who are millennials is the market risk alone. But that's not the only risk. There are four risks actually. There is market risk, which is the price risk. The change in price of your portfolio every day is market risk. Change in the power of your money is inflation risk. Over long periods of time, it becomes a very, very strong risk. If I could buy something in 1980 with 100 rupees, today I need 4,800 rupees to buy it. The same commodities, now I'll need 48 times more money. If your money is not going to grow more than 48 times in these 43 years, 44 years, you've lost out the purchasing power. Not the optical power, but the purchasing power. The third risk is your liquidity risk. Indians don't respect liquidity risk so much. I have met people who have maybe a 50 crore net worth, but they cannot access their 49 crore, 30 lakhs on a click of a button. So their net worth might be 50 crores, but their wealth is only 70 lakhs. because they can't access that money. They have to sell it. So liquidity risk, inflation risk, and then market risk. But unfortunately, the mind share of an investor when it thinks of risk is only market risk, which I think deserves a change. So if you're going to take risk, you have to dissect risk into different buckets. And then I can't agree with Nilesh some more that यार risk के बगैर gain नहीं है, right? अगर आप उतार चढ़ाव नहीं सहन कर सकते तो आपको एफडी से 3 गुना ज्यादा रिटर्न क्यों मिलेगी, right? And equities actually on a 10-year time frame has not lost money unless you plant a tree and pluck it and check whether it's growing every day. If you leave it alone, it like Dhirendra sir also said, if you leave it alone, you will make money. That's not a risk at all in long term.